Hello, future home buyers, especially those of you who may be first-time home buyers or not very familiar with the process and what it looks like to be able to qualify for a mortgage. And you might be wondering, how much mortgage can you afford? And you could go onto those online calculators, and we have one too. In fact, what I'll do is I will link in the first pinned comment and also the description to our home affordability calculator, where you can get an idea as to how much home you could afford. And that's using a lot of averages for taxes and whatnot. And it assumes that you are getting an FHA loan, so it's factoring in the mortgage insurance premium too. But when it comes to how much mortgage you could afford, so much of it is, I'd say, going to vary depending on A, you, or B, where you're looking. So, for example, you've got two things two measurements. It's the front end debt to income ratio and the back end debt to income ratio that come into play here. The front end ratio is solely looking at your income divided into, or your proposed mortgage payment divided into your gross monthly income. Okay, so let's say that your gross monthly income is $10,000 and your proposed mortgage payment is $3,000. 3,000 into 10,000, that's 30%. So your front end DTI would be 30%. Your back end debt to income ratio would be your gross monthly income again, right? But the difference will be that it's not just the proposed mortgage payment that you're dividing into it, it's all the other payments that show up on your credit report. Maybe your car payment, maybe you've got a student loan, you've got minimums on your credit cards of $100 here or $50 there. You add up all of that and your proposed mortgage payment, principal, interest, taxes, and insurance, divide that into your gross monthly income, and let's say that number was $5,000 divided into the $10,000. Now you're at 50% DTI. Okay, so these are at a high level what the loan officer would be looking at when trying to see how much you can get approved for. Now, I said that there are a lot of things that play a role here, and the first thing I said is you. So I say you because the first thing on the you side is your credit score. And why does that matter when it comes to how much you could afford? Well, the rates you're offered are also tied to your credit scores. So the better the credit score, the lower the rate. And the lower the rate, the lower the proposed payment, which means you're going to be able to afford more of a home. So if you have not been taking care of your credit, then you're not going to be able to afford a home or you're not going to be able to get approved for a mortgage that is as high as what you potentially would have gotten approved for if your credit scores were higher. Again, because of that difference in your rate. And I've seen where, the difference in the rate could be, at least 1% between someone who's got good credit versus bad credit. And that could mean that you qualify for a home that's $75,000 less, for example, depending on all the other factors and interest rates that are out there. So your credit score does play a role. So that's the first thing. The other thing is the other factor, because you're not going to do that much about your income unless you're going to get a cosigner. A cosigner brings additional income plus their debt to the mortgage application, and that could help you to be able to afford more of a mortgage. But let's set that aside. The other thing is well, where are you looking and what are the property taxes? Because your payment is not just about the mortgage itself. When the lender looks at approving you or getting your pre-approval, we're looking at also what the property taxes are going to be on the home that you're buying. So if you're buying in an area where property taxes are higher, you will afford less of a mortgage and you'll be able to afford less of a home. The other thing that comes into play here are homeowners insurance. So what is it about the home that you're looking at that could potentially raise or lower the proposed homeowners insurance? Not mortgage insurance, homeowners insurance. I misspoke there a second ago. There is also mortgage insurance. So the homeowners insurance. So if you're in a floodplain, let's say you want to buy a house on the water or it's in a flood zone. Now you will likely need flood insurance, and if you do, that means there's less monthly payment going towards your mortgage and more monthly payment to another insurance policy. You see where I'm going with this? So where you're shopping for a home definitely will play a role. So I can't tell you on this video exactly how much mortgage you could afford, but a lot of these things play a factor. And that mortgage calculator, that home affordability calculator that I'm linking to down below, will ask you to plug some of those numbers in so it can give you an idea. All right. But in the end, the best way to figure this out is for you to contact us at dreamhomefinancing.com, and we will help you to figure out how much you can afford based upon your personal scenario and your situation. Because the other things that come into play, whether it's the car payments, whether it is the credit card minimums, if you've got student loans that are deferred, these kinds of things also impact that. And we may find creative ways to overcome a couple of those. Maybe instead of you putting as much down, pay off something that may be smaller in balance but has a high monthly payment that's preventing you from qualifying for as much as you'd like. These are things that we all review with you one-on-one and can help you to squeeze the most out of your mortgage approval. Again, follow us at dreamhomefinancing.com. Thank you for watching. If this was helpful, please hit that like button. I appreciate it. And we look forward to speaking to you when you call us. Have a great day.